Hello and welcome to today's virtual coffee talk webinar. My name is Margaret and I will be your web host for today. We have a few housekeeping announcements and then we will introduce our speakers. In order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 of the 4 interactive questions. There will be a course evaluation which will open in a new window upon exiting the webcast at the end of the program. And with that, I'll introduce our speakers. Kevin M. Jacobs is a managing director with Alvarez and Marsal Tax in Washington, D.C. and the National Tax Office practice leader. He brings more than 15 years of experience in tax matters in both the public and private sector. Allison Hoeinghaus is a managing director with Alvarez and Marsal Tax LLC's compensation and benefits practice in Dallas. She helps companies effectively and efficiently tackle paying and incentivizing their employees. James Deets is a senior director at Alvarez and Marsal Tax LLC in Dallas as well. He specializes in executive compensation, employee benefits, and qualified retirement plans, and has served as a consulting expert on employee benefits issues within the context of bankruptcy proceedings. Finally, Kevin DeYoung is a lead product manager with Wolters Kluwer Tax and Accounting. Later, he will be showing us how to find additional answers and resources using CCH Answer Connect. Thank you. Kevin, take it away.
Great. Thanks, Margaret. And thanks, everyone, for joining us today. I'm really excited to have Allison and James back to discuss comp and benefits. When you're thinking of year end, everyone's thinking, okay, there's bonuses and the like, and obviously that's one of the things that people talk about. But overall, there's been a lot of interesting developments and newest and latest and greatest thinking that we're going to be discussing on this webinar. Touching on Section 280G, what does it mean? What are golden parachutes and the like? And then CIC benefits research, the A&M team has recently come out with a report that we'll be discussing the M&A comp issues, payroll tax issues, SEC Clawback Rules, and if that's not enough, then Kevin's going to show us how we can research everything that we've talked about on Answer Connect and find all of our fun researching needs satisfied. But with that, not to hold up the process, James, why don't we start talking about 280G and what should people know about it?
Sure thing. So welcome, everybody. Thank you for joining us today. So we're going to talk about, I'm going to start off here talking about Section 280G of the Internal Revenue Code. For those of you who are not up on code sections, which is probably most folks, these are also commonly called the golden parachute rules. And what they're intended to do is to prevent or deter excessive payments to certain individuals in connection with the change in control of a corporation. It doesn't apply to everybody. It applies to folks that are called disqualified individuals, and that would include officers of a corporation, as well as 1% shareholders, and then highly compensated individuals. And highly compensated individuals are defined as the top 1% of employees when ranked by compensation for the 12-month period ending on the change in control date. So that's the population that it applies to. It's really intended to protect the interests of shareholders, just to avoid excessive payments to the top folks in the company. And one thing to note is 280G, it only applies to corporations. It applies to both public and private corporations. It doesn't apply to S corporations, partnerships, or LLCs that are taxed as partnerships. So there is a limited category of entities to which it applies, as well as a limited category of individuals. However, I would note that in almost every transaction, public and private, there is going to be some potential 280G issues, so there will always be a need to look at the calculations, and we'll talk about how those work here in a second. But to look at those and make sure that no one's over their limit, because if someone is over the limit, there are things that we can do, things that can be done to correct that or to minimize the impact of 280G. But it's important to keep it in mind, to keep this section in mind and connect in the context of change of control of the corporation. So what is Section 280G and how does it work? We'll kind of dig a little bit deeper here. So golden parachutes, or parachute payments as we typically call, are benefits or payments that are received in connection with a change in control. Some of the possible benefits are listed here. Accelerated vesting of equity is listed there. That's typically the biggest thing that we see, or the largest portion of parachute payments. And then there's a number of other things. For example, a transaction bonus. A lot of times in the context of a corporate transaction, the executives will be given a transaction bonus. The other thing about 280G is that typically anything that happens within 12 months of a change of control is going to be presumed under the regulations to be related to the change of control. And that's why severance is listed here. Typically when I'm working with a client, we'll say, well, what severance rights do people have? They say, well, yeah, we're selling the company, but nobody's going to be terminated. The issue is, though, is that if someone does get terminated within 12 months of the change of control, the regulations are going to pull that back into the calculation. They're going to say, well, because it was within 12 months, it's presumed closely related to the change of control, and therefore payments that are triggered by that termination are going to be treated also as parachute payments. So that's why we pick up severance. Pro rata bonus is another thing. Quite often in a change of control, we would see executives entitled to a pro rata portion of their bonus based on the portion of the year that's passed as of the change of control. It's just something to make the executives feel like they're going to be protected on their bonus rights. And then some of the other things listed here: continuation of health and welfare benefits, outplacement services, those would typically be provided in connection with the severance payment. But there's a number of things that can be treated as parachute payments. For example, if there's an acceleration of the payment of deferred comp, then that would also be, there would be a portion of that would be treated as a parachute payment. So there's a myriad of things out there that can be parachute payments. So it's important to keep a very broad perspective when looking at 280G. So what happens if someone goes over their limit? So basically what we do is we're going to compare payments that are contingent on the change of control to the disqualified individuals. We also call them DIs. We're going to compare that to their historical comp. And I'll show you a little bit more detail on that on the next slide, but we're going to compare that. And if the parachute payments exceed a certain multiple of historical comp, then it triggers a lot of bad things. Number one, it imposes a 20% non-deductible excise tax on the recipient of the parachute payments. And then also would disallow corporate deduction. There's also an interplay between 280G and Section 162M. Section 162M is the $1 million limitation on deductibility of compensation for certain individuals in a corporation. So to the extent there's an excess parachute payment, not only is that excess parachute payment not deductible, the amount of that payment also reduces the $1 million limitation. So it's almost like a double whammy. So what do we do? One thing that we're going to talk about when Allison takes over, we're going to talk about our change of control report, is that quite often companies will implement protections for their executives that try to prospectively determine how they might be able to mitigate the impact of Section 280G. We'll talk about that in a little bit, but basically those protections allow the executives to stay focused on what they're doing and not worry about what might happen to their tax situation that connects with the change of control. Our next slide here, this is kind of a graphical explanation of how 280G works. And you'll see when we get to the end of this, we're going to kind of work from left to right. When we get to the far right side, you'll see how 280G can be very punitive. So we start on the left side. This is the historical comp I was talking about. It's called the base amount, that first column there. So basically what we're going to do is look at 5-year average W-2 box 1 comp. So it's what was taxable comp for the 5 years ending in the calendar year prior to the change of control. So if we have a change of control of 23, we would be looking at 2018 through 2022. So we take the average W-2 box 1 comp for that 5-year period. If someone wasn't employed for 5 years, then we're going to look at the average over their period of employment. Partial years, for example, if someone's hired in June and they only have half a year of pay, that's going to be annualized. So people aren't going to be penalized for being hired in the middle of the year or not working the full 5-year period. So we get that average and we triple that, and that becomes our safe harbor. That's the second column, second blue column there. So we triple that, that's our safe harbor. And then we look at our parachute payments. Third column has some example, potential parachute payments. So we would add all those parachute payments up. And here we have severance payment. We have equity vesting, which is, as I mentioned, is typically the biggest portion, maybe some other benefits. And to the extent the parachute payments exceed that safe harbor amount, that's going to trigger the 280G excise tax. Now, the issue here, what makes it really punitive is that the excise tax doesn't apply to the amount that exceeds that 3 times the base amount. It doesn't apply to the amount that exceeds the safe harbor. It applies to the amount of the payments that exceed one time the base amount. So in this example here, let's say, just for simplicity, we had a base amount of 100,000 and a safe harbor of 300,000, and someone had $300,001 of parachute payments. That's going to trigger the 20% tax on everything in excess of 100,000. So we, in effect, would have $200,000 times 20%, or a $40,000 excise tax just for going over that limit by $1. So it can be it is very punitive the way that this works. So that's an overview kind of how the calculation would run. So our next slide.
Yeah, and just James, one quick thing just to note. As you noted, I just want to note for the participants, the slide is sort of a misnomer from the words are right, the graphic is a little tinkered with, in the sense of, as James noted, it is the excess over the tax base amount. So here it would actually be to the top of the equity vesting, and not just capped out at the 3 times safe harbor. So just wanting to call that to people's attention when they're looking at this.
Yep. Good point. Yep.
One other thing I'll just add in here, James, is, one of the things just in practice that we see a lot of times, companies will think, oh, our benefits are fairly modest, we're not going to have issues with 280G. But one thing we see that people get caught up in all the time is, again, 280G has this historical look where you're looking at this 5-year average for the base amount, and then the safe harbor. And so a lot of times we see some of the people that get caught up unexpectedly because, one, they're new hires and they don't have that 5-year average, where maybe they haven't had, equity vestings that have occurred to kind of bump up their W-2 to a normal level for that type of executive. But then also we see individuals that have been internally promoted. A lot of times they get pulled into these roles and have issues under 280G because, again, their base amount hasn't really caught up with the level that they're at now, because they have this 5-year average. It was based on, maybe they were a controller or something, and now they're the CFO, and that historical look hasn't caught up. So just want to point that out, as a lot of times, companies think that oh, they won't have issues a little bit further down the ranks, or not at all. But oftentimes promotes and new hires get caught up in these roles because of the look back.
And one other point I want to make kind of along those lines, Allison, I'm glad you brought that up, is board members. So if you recall, we have our DIs. There's 3 categories: officers, shareholders, and HCIs. The board members, rarely, it's never going to be an officer of the corporation. It'd be very rare to see that. They're usually not going to be highly compensated because board fees are relatively low. But in many instances, particularly in the private equity context or private company context, we might see a founder of a company that was acquired stay on as a board member, and they might still be holding 1% or more of the stock. That makes them a disqualified individual, because DIs includes not only employees, but anybody who provides services to the corporation. So that would pick up board members. And board members' comp is typically pretty low. So to the extent you have a 1% shareholder board member, they're almost always going to exceed 280G to the extent they're holding incentive equity that's going to vest in connection with the change control. So that's just a little gotcha there to keep in mind. So there are some exemptions from 280G. Number 1 is a small business corporation, otherwise known as S corporation. So if you have a corporation that could qualify as an S corporation, even if it hasn't made an election, that corporation is going to be exempt from 280G. Number 2, the tax exempt entity, as long as the entity meets the definition of a tax exempt organization, both before and after the change of control, 280G will not apply. There may be some other rules that apply in the nonprofit context that are not really within 280G, but 280G itself would not apply. And then the third one is probably the one that we see the most often for non-public corporations. There is a shareholder approval exception. So this is really common in the PE context, and in any private company. We're going to see the shareholder approval used. And the way that works is the executives have to put their excess payments at risk. So they basically have to sign a waiver saying that I agree to forego these payments unless 75% of the shareholders entitled to vote approve the payments. There has to be a detailed disclosure to all the shareholders intended to vote. It can't be just to the, say you have an 80% shareholder, and then 20% of the shares are held by other folks. The notice has to be given, and the right to vote has to be given to all the shareholders. The client can't just say, well, we'll just have this one 80% person vote because they're going to meet that 75% threshold. So it's all shareholders. And that can be one area when that can cause a little bit of heartburn, especially if some of the top guys are getting significant payments. They can sometimes be a little bit antsy about all the shareholders being privy to the total universe of payments they're going to receive. Although usually once they consider the tax impact, the angst reduces and the shareholder approval is done. So that's one that we see the most often used way to get around the negative impacts of 280G. So once the shareholder vote is done, a couple of other points on that. The transaction itself cannot be contingent on the shareholder vote. The executives have to honestly waive the payments so that if the vote is not successful, they forego those payments and they can't get them back. So there is some risk, but usually by the time it gets to a shareholder vote process, there's enough equity concentrated in just a couple of shareholders that it's, rarely, if ever, would a shareholder vote be, would the waivers be done and the shareholder vote sought if it wasn't, relatively certain or almost 100% certain that the vote would pass. So, but that's very common, and see that in almost every private transaction. There will be a number of people over, and the shareholder vote will be used to cleanse the payments, which totally eliminates any negative impact of 280G. So let's go on to the next slide. Mitigation concepts. So there are some ways to address 280G issues. Base amount planning is the first one. So as I mentioned, the base period, or that 5-year period, is the 5-year period ending in the calendar year preceding the calendar year of the change of control. So if you're in the current year and you're going to have a change of control, base amount planning won't work because that period's already fixed. But let's say, and I'm actually working on several cases right now where the change of control is going to be at some point in 2024. And so that allows some base amount planning. So what is base amount planning? The way that works is you try to pull payments that would otherwise be made into the current year. For example, maybe accelerate the annual bonus or a portion of the annual bonus for 2023 into the current year instead of waiting until March 15th or whenever it's typically paid in the following calendar year. So that would serve to push up the base amount to some degree. I've had other clients where they exercise non-qualified stock options. There was a large amount of stock options that were already vested that were going to be cashed out in connection with the change of control. And instead of waiting till the next year when the change of control occurred, the client actually exercised all of her stock options, and that resulted in a very large W-2 Box 1 amount for the current year that went into the base amount calculation for the following year. So there's a number of ways to accomplish base amount planning, but to the extent payments can be pulled into the current year, that can help with the calculation. One thing to note, though, is that as payments are pulled into the current year, that causes at least a portion of those payments to become parachute payments themselves. For example, if there's a payment that would be made at some point in the following year and it's accelerated 3 or 4 months, there might be a time value of money factor that goes in there. So a portion of that payment is going to go into the calculation, but generally when base amount planning is done, the amount of the increase in the parachute payments is far outweighed by the benefit of bringing that income into the current year. And then reasonable compensation are a couple of concepts here. I'm going to talk about first the reasonable compensation after the change of control, which is at the bottom of the page here. So to the extent a payment can be treated as reasonable compensation for post-CIC services, that comes out of the calculation completely. In many cases, most of the time where we see this is severance payments are often treated as reasonable compensation for a non-compete. And so to the extent there's a large severance payment and that represents reasonable compensation for not competing, that can come out of the calculation. And in many cases, that can actually cause individuals who are over their limit to come in under their limit. And then the second concept, reasonable compensation, is for services rendered prior to the change of control. And the way that one works is the payments that are treated as parachute payments, they still remain parachute payments, but they can be backed out when the tax is applied. And so I've had certain cases where, let's say, the parachute payments consisted of performance-based equity compensation that was going to be cashed out, but because the performance-based compensation it came about because of services rendered prior to the change of control, to the extent the to the extent those payments represent reasonable compensation, those can come out of the calculation. So in some cases, you can have all the parachute payments eliminated from the tax piece. So they still have excess parachute payments, but to the extent they can be treated as reasonable compensation and taken out of the tax calculation, you can actually have someone that's over their limit with a zero tax. So these are just some ways. It doesn't usually will not be that good, but I've seen it work like that. But in any event, that will serve to reduce the amount of tax that would otherwise be applicable. So these are just some of the concepts that can be used, and it does take some planning, but there are ways to reduce or eliminate the impact of 280G.
Yeah, James, I'll just add in here that really, we get the best bang for our buck, right? If we can combine all three of those. It doesn't always work in the fact pattern, but I think just one best practice is as soon as you know about a transaction being on the horizon, get started on this as soon as possible, because there are things like base amount, right, that the timing, you could lose out if you don't do it in the year before. But then also even some of the other components, these are often highly negotiated between the parties, and they take a lot of work to kind of figure out the ideal situation. But in particular this time of year, James, I'm working on several base amount planning, to accelerate amounts into 2023. Just a couple things I want to highlight there is, sometimes it could be stuff where it won't even affect the parachute value, because it could be things like I'm working on one right now where they have stock appreciation rights that are already fully vested. In fact, they're about to expire. So them going ahead and exercising those, there's really no 2DG impact because they're already entitled to vest those. So it's really like, why it's kind of a no-brainer, right, to go ahead and exercise those so that you can bump up that base amount. The other thing I'll just warn is, if it is something that's otherwise going to be paid in a future year, we got to be careful about 409A, so that we're not just swapping 120% excise tax for an additional 20% under 409A. That's something we've seen get caught up in particular around equity awards. Maybe you have retirement vesting provisions where an individual is already deemed to be vested in those awards, where they do not fall under the short-term deferral under 409A. Those type of awards, that could be one that kind of lurks under the surface and is easy to miss, that maybe you can't accelerate those payments because you would have a 409A violation. So it's one of the things that anytime we're doing the base amount planning, also being sure that we're keeping 409A in the front of our mind to be sure we don't trip up on that as well.
Yeah, good point. So this is just kind of a graphic of reasonable compensation, some of the things that could be pre-CIC versus post-CIC reasonable compensation. I mentioned the performance-based stock awards. Pro rata annual bonuses often would be treated as pre-CIC reasonable comp. Performance-based long-term cash. And then post-CIC, we talked about non-competition. If someone's going to stay on under a consulting agreement, then that's obviously payments under that agreement could be treated as post-CIC reasonable comp. And retention bonuses would be another example. And there's a number of things that can fall under these different categories. This is just intended to kind of give you a flavor for what types of things, what types of compensation might be treated under these reasonable compensation exceptions. I think with that.
And just James, just a note, I mean, this section really goes to show why December is the right time to be thinking about this, right? Because a lot of people are always thinking, oh, we should try to close a deal immediately before year end. And, there are the benefits, as you're saying, with regards to the base year of the difference of a few days, i.e. December 31st versus January 1st, can have a potentially big impact on some of these calculations. And so there are always this push-pull of when you rush to close a deal and think about these things. And so for those out there that are thinking about or in the process of closing, obviously this should be top of mind, as well as factors to think about as the impact on closing.
I think it's a great point, Kevin, because on the two deals that I'm working on right now with the base amount of planning, one of them is solving everybody and alone with just the base amount acceleration. And the other deal, it's probably solving like 50% of the people. So there can be a lot of a lot of dollars there if you can plan ahead. Okay, with that, we'll shift into the change of control benefits research that our team has recently completed. So you can see here, we have an executive change of control report. This is a report we've done basically every other year for the last 16 years or so. And we just released our latest version right before the Thanksgiving holiday. So this is hot off the press. This evaluates the kind of the latest trends in change in control benefits. So it goes very hand in hand with the 280G rules that James just went through. Historically, our team has kind of looked at this from an industry perspective and kind of evaluated different trends across industries. But this year we kind of decided to change it up a little bit, and we're actually looking at how change in control benefits vary based on the size of the organization. But we still do have some insights into industries as well, kind of peppered throughout the report. So from a size perspective, we broke everything. We're looking at 100 companies in the S&P Composite 1500, and we broke them into small, mid, large, and mega cap, so that we could evaluate the differences across size. And then we evaluated the various types of benefits that CEOs and CFOs receive at these companies. So you'll see here there is a link here at the bottom of the page where anyone can click on the link and go to the full survey results. We have an interactive page that the link goes to directly, where you can actually kind of play and click on the different sectors or sizes of companies and things like that, and see how the results change. And then you can also download the full PDF of the report. So it's got a lot of great information in there. If you're looking to benchmark how your practices stack up against similar sized companies, it'll be very helpful. What we thought we'd do during this time frame is just kind of highlight some of the key takeaways from the research to kind of give a flavor of the results. So here you can see the first thing that we looked at is change control severance for CEOs. So on the left-hand page, we looked at the multiple that is often given when calculating severance for CEOs. And so down below, you'll see, less than 1, 1 to less than 2, and the various severance multiples. By far, the 2 to 3 multiple is the most common, with 60% of CEOs getting that. And then 3 or greater is the next most prevalent at 28%. So these can really add up very quickly with 2 and 3 multiples. And then what is that multiple applied to? You can see in the chart on the right-hand side, the multiple is applied to some sort of definition of compensation. And again, by far the most common at 90% is the sum of base salary and bonus, but about 7% apply it to only base salary. Now, the bonus definition varies across the organization. Some use target, some use actual bonus, or some sort of historical average. There was just a handful of companies that also have some other type of definition, just 3%. Most of the time that might be where they added in, say, an LTIP component, or maybe use W-2 compensation instead as that definition of compensation. Okay, next slide. So as James alluded to earlier, by far the biggest component of change in control benefits for executives is around long-term incentive or equity awards. So one thing that we evaluated in our research is accelerated vesting of those type of awards. The single trigger here, as this is often referred to, is where the awards vest solely upon a change in control. That's all that has to occur for them to receive accelerated vesting in connection with a change control. So 9% for that. But by far the most common is actually double trigger, where there's acceleration of the vesting if both the change of control and an involuntary termination of employment occurs. So 88% there. This, going back to when we started this survey, these used to be a lot closer, and single trigger was much more prevalent. But over the last 10, 15 years, double trigger has taken over as the most prevalent. It's definitely what ISS and Glass Lewis and a lot of the shareholder advisory firms want to see, is more that double trigger vesting. And then there's a handful, just 3% of companies, that leave it kind of up to the board's discretion at a later date.
I guess one thing I want to point out here is that that our report is focused on public companies. Obviously, it's all what public companies do. So in the private context, you would almost always just see single triggers for the LTI, or for cashing out incentive comp. So it's just one of the differences between the private and public company.
Good point. Okay, this next slide shows other benefits that are fairly common in change of control situations. So health and welfare is definitely very common at 63%. This usually is, just continued participation or coverage under the employer health and welfare plans. A lot of times the time period that this is covered for aligns with that severance multiple that we discussed earlier. So if they were getting 2 years of base salary and bonus, a lot of times they'll have 2 years of health and welfare, but not always. Sometimes companies will cap it at, say, 18 months. And it's also very common that if they do receive coverage under a subsequent employer's plan, that coverage would cease. Outplacement services, so this is also fairly common at 22% in terms of employers providing outplacement services to help those individuals find their next job after the change of control. And then finally, an enhancement of retirement benefits at 15%. This can come in lots of different flavors. Sometimes it's just a matter of accelerated vesting of any unvested balances from, say, matching contributions or things like that. But it can also take the form of additional years of age in service when calculating the underlying retirement benefit. So, for example, as I mentioned earlier, severance might be 2 years of base and bonus. They might get 2 years of health and welfare, and maybe they'll get 2 years of retirement contributions that the employer might have otherwise made during that 2-year period. So that's just kind of some examples of what that might look like. And on the right-hand side, as we talked about earlier, again, 2AG is very punitive. It can be really costly if you're over your 2AG threshold. So how do companies deal with the impact of 280G? 15 years ago, it used to be very, very common for companies to provide excise tax gross-ups, where they would essentially cover that 20% excise tax. But these got to be really, really expensive because anytime that 20% was covered for the employee, that in and of itself also became a parachute payment. So there's kind of this like circular reference, and gross-ups are very, very costly. So this is something that ISS, Glass Lewis, all the shareholder advisory firms definitely think is a poor pay practice. So essentially you can see here, we only saw 4% that still have gross-ups. And most of the time, these were just legacy agreements where, they've had the same agreement for a really long time and it just keeps getting renewed. But we've seen as more agreements get renegotiated or entered into new ones, that this gross up is definitely coming out of those agreements. The next excise tax protection that we looked at is cutbacks. You can see 10% of companies had that. This is essentially, if we think back to that chart that James was going through, and that little sliver of equity awards that was above that top line, cutback would be basically them just giving up that amount that was over the top red line so that they're below their 280G threshold, and they no longer don't trigger 280G and don't owe the excise tax. The issue with cutbacks is, the value could be really large if they're over that top value. So what we see more commonly is actually the next one, which is the best net provision. You can see 41% of companies have best net. And this is essentially looking at what's better for the executive between reducing that amount that's over the top red line to get them under their 2AG threshold, or paying them everything that they're entitled to under the agreement, and they just have to pay the excise tax themselves. So whichever of those is better for the executive on an after-tax basis, that's essentially the best net provision. So very, very common because it's better for the executive, right, in terms of what's best from a tax perspective. And from the employer's perspective, it's better because then they at least have a chance of preserving their tax deduction if it's better for the individual to be scaled back. So again, very common. You'll note here, though, there's a lot, 45%, that just say nothing. And this is fairly common for us to see, in particular with some of the bigger companies, because they're just not as worried about this because, who's going to buy, some of the mega cap companies, right? They're just so huge. But I think this is also because a lot of times this is something that companies will add in if there's actually a real deal on the table. So they just kick the can down the road, and then they'll deal with it whenever an actual deal is on the table. So I would say that even though it only shows 41% for best net provisions here, in practice, we see a lot more than that. It's just they get implemented once there's actually a real deal on the table. Okay, next slide, and I'm just going to go through this quickly, but this is actually a screenshot that if you go to that link and you can be on our interactive page, at the top, those are all buttons where you can explore the various components of the change in control benefits and see how they change depending on the market capitalization. So one thing I'll just kind of point out here is we're also showing change in control and non-change in control severance. And so the thing I wanted to point out here is on average, change in control severance is roughly 2.1 times non-change in control severance for CEOs. So there is definitely a premium that occurs if the severance is coming about because of a change in control of the company. And with that, I will hand it over to Kevin for our first polling question.
Great. So we're going to launch our first polling question. Please, again, remember to fill it out so you get credit. Have you ever been part of a change of control transaction? No, yes, once, or yes, more than once. While you're filling that out, we're going to keep going to other M&A compensation issues. But I guess, James, before we do that, going back to the previous section, we talked about being mindful of the application of 280G, and if you switch something up to avoid 280G by moving it forward to the base year, we have to be concerned about 409 Cap A, but we really didn't talk about 409 Cap A. So do you mind just giving like a really high level brief background on what that is?
Sure, not a problem. I'll give a 30,000 foot perspective. So 409A is a statute that was enacted back in 2000. I don't want to date myself. It was early in the 2000s in response to the Enron debacle. And what 409A does is it sets very strict limitations on when deferred compensation can be paid and when it can be when the payment can be accelerated. And so in some cases, if there is some deferred compensation, it's a very broad definition under 409A, but basically 409A sets some pretty strict limitations on how you can treat deferred compensation. And to the extent those are violated, then it would trigger a 20% excise tax that would be applied to the executive. And so as we move around payments, we have to, number one, make sure that if we're going to accelerate a payment, that it's not subject to 409A, and if it is, that it otherwise might be subject to an exception that would allow it to be accelerated. So that's just a little, and we could do 2 or 3 hours on 409A. It's a very complicated statute, but basically that's just the construct around deferred comp and how it has to be treated for tax purposes. So hopefully that was helpful. And I think what's our next slide is going to be earnouts. Okay, I'm going to talk about earnouts. So earnouts, typically what an earnout is shareholders that sell a company, and many times there'll be some amounts that are held back, and then it's paid out to the shareholders based on different factors. For example, sometimes it's, what's the company's EBITDA? Do we hit certain targets? And we're going to pay this, we're going to release this amount from escrow to the shareholders. And so a lot of times when a company is being acquired, what is really being acquired is people, it's talent. It's not necessarily a manufacturing business where you've got machinery and a lot of things. It's a lot of intellectual property basically that's contained within the minds of the folks that work there. For example, especially in the consulting business, if there's a consulting business that's being acquired, a lot of times the buyer's like, well, we want to make sure that the top guys stick around. And so quite often there will be requirements that in order for, say, a founding shareholder to receive an earnout payment, they have to stay with the company. And so this raises an issue of tax treatment because under the IRS rules, if someone is getting a earnout payment and it is tied solely to their continued employment, that's going to have to be treated as compensation as opposed to capital gain. So there's many factors that can be considered as to whether an earnout, if there is an employment requirement, as to can an earnout be treated as capital gain versus compensation. And obviously the shareholder is going to want it to be treated as capital gain. It's generally more advantageous for the company, for the acquiring company, if it's treated as comp. But usually the comp treatment for equity payments quite frequently can be a deal killer. So we don't like to see that. So there's several factors to consider. Indicative compensation would be if the payments or the amount varies based on the length and type of service of the person receiving them, or if the person's required to stick around, that's indicative of compensation. And I have one client that really focuses on keeping folks in their seats, especially founders. But there are ways to get around that by structuring the earnout so that maybe there's some other factors. Maybe there's not only does the founder have to be there, but there has to be a certain limitation on the amount of attrition among the rest of the workforce. So there's ways you can layer on different requirements to try to get to avoid the comp treatment. Some of the factors that indicate sale proceeds. One question is, assuming all the earnouts are paid, would the founding members who are subject to the earnouts, would they end up getting the same amount for their shares as non-employee shareholders? That's indicative of sale proceeds or capital gains treatment. Another question is, if the founder didn't receive the earnout, would they still have competitive market-based compensation without regard to the earnout? That's indicative that the earnout really is payment for shares. And then the third factor is, does the overall payments, including the earnout, is that a fair amount for the shares? And then there's the third column there is indicative of either. How does the transactional documents classify the payments? Are they intended to be classified as and it's not necessarily going to be dispositive, but because it's a facts and circumstances test. But the documents can say, here's how we intend them to be treated. How are they going to be reported to the IRS? And then third, or the final one, how are they reported for non-tax purposes, such as financial accounting purposes? I would just point out here that to the extent there's an employment requirement, that for financial accounting purposes, they're going to be treated as comp, but that doesn't necessarily going to have to correspond with the tax treatment. So I don't want to take up too much time there. I know we're starting to run short of time, so I think we can move on from here.
There's just one thing I do want to note, and you're completely right. Like, it's normally the incentivized to say, oh, I want to have it as sales proceeds, so therefore it could be capital gains. With that said, I was working on a public deal that involved the tax-free reorg, and the earnout was going to be paid by cash. And if that was part of the sales proceeds, it would actually potentially jeopardize the tax-free reorganization. And so as a result, we actually structured the earnout to be part of compensation, to pull it out of the metric, so therefore the transaction still qualified. So just to sort of highlight, there is this back and forth between what's happening on the compensation, what's happening on the income tax, and trying to be mindful of structuring the deal most efficiently.
Okay, so quickly I'll just highlight two things here around stock options. This is often, where upon a transaction, if the equity is being carried over, you have to adjust the stock options usually in order to keep executives and other employees whole on this. There's two code sections that kind of come into play here: 49A, which we already touched on, deferred comp rules, and then 424, which is the incentive stock option code sections. And they both use these two tests, the spread test and the ratio test. I'm just going to highlight this very quickly, though. There's an example to the side, but essentially the spread test is just being sure that the intrinsic value of the old option, you still have the same spread whenever you get the new option. So in this example here, you could see they were $5,000 kind of quote in the money, and we want to be sure we preserve that, in the moneyness, if you will, of those options. The second test is the ratio test. This is looking at the ratio of the exercise price to the fair market value, and depending on which code section you're looking at, it either cannot be greater than or more favorable than the ratio before than it is after. There is some differences among practitioners on exactly how the ratio test comes into play in various scenarios, but just for purposes of this presentation, if you try to keep the ratio the same, you're good under both of these code sections. So with that, I'll just quickly go to the next slide. Why does that even matter? Why do we want to be sure we adjust stock options appropriately? Well, for the 49A reason is that if you don't adjust them in a manner that it satisfies 49A, then the options are subject to 49A, and they have to only pay out upon permissible distribution events that are prescribed under 49A. And if you violate those payment dates or distribution dates, then the consequences are that the employee will recognize that income on vesting rather than when they exercise the awards, and the deduction will be accelerated from the employer. There's also, as we mentioned earlier, an additional 20% tax as well as interest that comes into play here. For incentive stock options, so under 424, the consequences here is that the employee will lose that tax qualified status of their incentive stock options. So incentive stock options, if you do not have a disqualifying disposition, they generally get capital gains treatment, so they're not included in ordinary income. But if you do not adjust these appropriately upon a transaction, then it'll be just like non-qualified stock options, where there will be the spread included in ordinary income. So that's why we just want to pay attention to these upon transactions. So that'll, James, I'll hand it back to you to talk about FICA reset.
Yeah, so just a couple of quick payroll tax issues. This really only applies if there's a transaction or a change in employment status in the middle of the year. If it's on the first of the year, then it's not going to be relevant because the Social Security taxable wage base resets obviously on January 1st each year. But the general rule is if there's no change of employment and the EIN remains the same, then FICA is just going to continue on. So there's no issues there. And there's some examples here. I'm not really going to talk through the examples in detail just because we're running a little bit short of time. Just want to kind of give you a broad brush here on this. And then the second corollary to this general rule is if there is a change in employment or the EIN under which the employees are paid, then we have what's called a FICA restart. And so each company, in that situation, each company would be responsible for payroll tax and reporting for employees for amounts paid to such employees. So in that situation, employee A, let's say, was working for company B in connection with a transaction, ends up going to work for company C under a different EIN. That employee is going to end up paying double FICA. Of course, the employee can get their portion back on their 1040, but the employers can't get their portion back. So it's a bigger burden for the employer in that situation. And the employee is also going to be provided 2 W-2s for the year, even though maybe they still sat at the same desk. For example, let's say that company B acquired company A in a statutory merger, that A merged into B, and so there's a new EIN. Even though that employee is sitting at the same desk doing the same job, absent some other circumstances, the alternative procedures, what we're going to talk about here, they're going to end up with 2 W-2s and then having to pay double FICA and then request a refund on their tax return. And of course, the company, even though it's basically the same organization, is going to be paying extra FICA because that taxable wage base will reset. So the alternative procedure is a way to get around that. And basically what happens if the transaction is one that would qualify for the alternative procedure, which generally is going to be a statutory merger or an asset sale, acquisition of assets where all the employees go with the buyer, then the buyer and seller can agree, let's use the alternative procedure. And what that means is the employees would only need to be provided 1 W-2, and each employer would pay their portion of FICA, but would get credit for the FICA that was paid by the other employer. So this avoids that double up on the FICA. So what happens here, though, is that each employer is going to file 941s for the FICA that they paid. And then one of the employers, usually is going to be the buyer, is going to file all the W-2s. So what happens there is when that goes into Social Security Administration, they're going to look at that and say, well, we've got this employer B over here, the acquiring employer, their 941s are showing, let's say, 16 million of wages, but they filed W-2s for 40 million of wages because that includes all the wages prior to the transaction. So there's a disconnect there, and that will usually trigger a deficiency letter. But the way you get around that is what's called a Schedule D, which stands for discrepancy. So if there's a discrepancy in your W-2s and 941s, you file these Schedule Ds, and that explains to the IRS and the Social Security Administration, this is why this doesn't match up, and that makes everything kind of okay, so to speak. And to the extent that employers get it wrong, I had one company that kind of did a restructuring. They moved some employees around internally, and they got deficiency notices totaling over $1 million. We were able to get it all cleared up by doing the Schedule Ds retroactively, but that's not ideal. Obviously, you don't want to have to have to resolve it that way. But there are ways, if the Schedule D gets overlooked or if something doesn't happen like it's supposed to, there are ways to get around all the penalties and deficiencies. So it can be fixed retroactively. And with that, let's maybe move on to the next topic. Oh, polling question.
Our polling question of how does your company handle payroll? We outsource it, we use a PEO or in-house. And so while they're answering that, why don't we start talking about the SEC Clawback Rules?
I'm happy to cover this just real quickly because I know we're short on time, but this is new rules that just went into effect December 1st, where all companies that are listed on the New York Stock Exchange or NASDAQ must have a clawback policy that comply with the applicable listing standards and that follow the SEC rules. So this is something that we're going to start seeing disclosures on, that companies must file the policy as an exhibit to their first annual report after December 1st. So this is something as we start seeing the 10Ks for December 31st filers, that this is going to be something that's out there. There's a couple of things to think about here. You know, clawbacks is not a new thing. There are other types of clawbacks already out there for other purposes, but this is specifically around the Dodd-Frank ones. And so the companies might have a reason to have multiple clawback policies. So there might be, some are choosing to kind of integrate these policies and just simplify and have one. But given how broad these rules are, some are also choosing to kind of have two sets of clawbacks. So it'll be interesting to see, you know, kind of how companies approach this, or have been approaching this now that we'll see as part of the 10K. We'll quickly just go to the next slide. I'm not going to address this at all, but this slide is a great visual that is kind of a helpful flow chart to show when these rules come into play and what are kind of the implications of that. So we'll just leave that as kind of a leave behind. But again, just to sum up clawbacks, this is something that's definitely a hot topic with the changing rules. The rules do, you know, the clawback is around things that are incentive-based compensation tied directly to financial reporting. So one of the things we've heard a lot about is this going to change design around, say, annual bonuses, where things like maybe strategic initiatives or things like ESG metrics, for example, that are not tied directly to financial reporting, if those might become a little bit more prevalent given the complexities around the clawback policies, and if those were to come into play, just how hard they are to comply with. So more to come on that. We'll be soon to see, but with that, we want to hand it over to Kevin to our last polling question and to close us out.
Yep. So what is the size of your company? Less than 100, less than 500, the 500 to 1,000, 1,000 to 5,000, or greater than 5,000. As Kevin gets ready to show us everything we need to know about Answer Connect, just wanted to take a minute to thank everyone for joining the virtual Coffee Talk series for the past year. It's been a great year, and thank Allison and James for covering comp and benefits. It's really important to keep these things in mind. As we talked about, it's not just limited to, okay, let's do the income tax and then figure out the comp and benefits. They really go hand in hand, and it's really important to keep these at the top of your mind. So with that, Kevin, what should we know about Answer Connect and going from there?
Excellent, Dan. Thank you all. Again, great presentation. Want to thank you for all of that. I second Kevin. It's been a great year with the Coffee Talks. Thank everyone for joining. If you've been to multiple of these, hopefully the information has been extremely beneficial. Did want to spend a couple of minutes here taking a look at CCH Answer Connect and how we can address some of the issues. We're going to focus on the golden parachute component for this demonstration and how we can get to the content and the information that we've put together here for you. When we created CCH Answer Connect, we tried to really look at how research was being conducted. From the standpoint of someone who is more experienced in research may actually know the code sections they're looking for and driving you to content and pulling all of that information together. But we also wanted to take a look at researchers who may be less familiar or less experienced in research, and how do we help them become more efficient in doing their tax research. So for today's example, we're just going to really quickly do a search under golden parachute. And I'm actually going to run a complete search here for us and get to our search results. One of the things that we do allow is some filtering and the ability to take a look at specific document types. One of the items that came up here is calculating the golden parachute payments. This is one of our explanations that ties directly into the code section that we had been discussing earlier on in the presentation. But to begin, I'm actually going to go over to our topic pages and spend a little bit of time talking about what we've done when we created these topics. I'm going to go ahead and
Kevin,
open up
I'm
now.
sorry to interrupt you, but we can't see your screen.
Is it not showing? I am sorry. Let me try again.
There we go.
Sorry about that. So I'm not going to go back, just an effort of time here, but what I've done is I've gone and filtered out after seeing my search results into my topics. And we're going to go ahead and jump into the topic page on limitations on compensation deduction. And what we've done here is aggregated quite a bit of information regarding this topic as a whole, where our explanation is focused on a very specific code section and discussing that information. Our topic pages look at the larger view of the issue. So you'll notice as we begin to look here, the left-hand side, we have a navigation pane, which will walk us through the content available on this page. The types of limitations that we have regarding the compensation deduction, covered employees, compensation. We talked about golden parachutes. I'm going to go ahead and click on this. We'll scroll further down into this page. And we'll begin to have discussions regarding many of the topics that were covered during this virtual coffee talk. We've also then brought in recommended topics. This is where we orientate you into where you are within the topic set of information. We also then pull in the relative primary source. As I mentioned before, many folks will know what code sections to go into. In many instances, if this is an area that's not as familiar, you may not. The editorial team has then brought all of this information to you for you to begin your review. We also then bring in any news, forms, practice aids, all to this location. From here, I'm going to jump directly into the code section for 280G, as we discussed earlier today, and really kind of just walk through how we've changed, how we pull all the information together for tax research. If you think about how tax research used to be done before, there were many databases of information. You'd have your code database, your regulation database. Explanations were scattered throughout the services that we all grew up using. In this case, we brought all of that information together here. And if you follow what we consider a traditional research path, you'll begin with your code. You'll then move into your regulations as we move across this tabular view. But what you'll notice is I'm not leaving this page. Therefore, all of the information is pulled here. I'm not getting lost by clicking on multiple links to get to multiple pieces of information. We have all the explanations tied into 280G in this location as well. All your cases, administrative guidance, we have forms, instructions, we have tools, client letters, all located here. What I did want to point out, though, is let's say as a researcher, you chose to go directly into that explanation or directly into code section 280G, and this was your starting point. One of the pieces that we were very careful and wanted to make sure is that all of the information was cyclical. So if I wanted to go back to that topic page, it's actually listed on my limitations on compensation deductions directly from this page. There's no longer a need for me to go back to a search result or to run additional searches to pull all of this information together. I'm going to take a couple seconds here. I'm going to jump over to Google search. One of the items that we do know is there's still going to be quite a bit of Google research being done. It's out there. It's a great source of information. I actually ran this search earlier for golden parachute, and I ended up on the Wikipedia page. One of the biggest issues that we ran into is the information contained within Google, first and foremost, right, and is it still current? So we now allow the researcher to link any document on the web back directly into CCH Answer Connect via our browser plugin. So what I've done here is I've highlighted section 280G, and I'm going to click on search within CCH browser search, which will then run that search again directly within CCH Answer Connect, therefore allowing me to get back into that code section view for 280G that we just looked at a moment ago and verify whether what I've just read in this document is still applicable current law, or have there been changes or modifications to any of the provisions. Again, just really allowing you to safeguard yourself as you use those third-party sources available to you on the web. One last item I did want to point out just very quickly as we talked about some of the SEC and the clawback rules. One of the items that we just recently added is an accounting and auditing tab. So all of our accounting and SEC guidance is now available on CCH Answer Connect, so you can address the tax issue as well as the SEC issues in relation to everything that we discussed today. So again, I want to thank you for giving me a couple of minutes to take a look at CCH Answer Connect. Margaret, I'm going to pass it back to you for the final polling question.
Thank you, Kevin. That wraps up today's webinar. CPE credit will be posted within 2 to 4 business days. You will receive an email notification with your certificate of completion. Today's webinar has also been recorded. You will receive an email with access to the link within 24 hours. Thank you all for attending and have a great day.